In this video, we will discuss the topic of liquidity and market manipulations, understand the concept of buyers and sellers, and learn who the major players are and what traces they leave on the chart. The main concept of buyers and sellers. In any market, there are always buyers and sellers. When you want to buy an asset, someone must be willing to sell it, and vice versa. This interaction creates market orders, which find their counterparts and create liquidity. In other words, liquidity determines how easily you can buy or sell an asset at a fair value without affecting its price. At the same time, the absence or predominance of liquidity on one side plays a decisive role in shaping market movements. Imagine a market where a popular stock is traded. If many people want to buy this stock, but few want to sell it, it means that the buying volume predominates and the stock price will rise. Conversely, if many people want to sell the stock but few want to buy it, the price will fall because the selling volume is greater than the buying volume. This is quite simple and logical. Accordingly, this is what we constantly observe in practice. Modern markets are almost always moving in one direction or another. Trends are always present, and large players have an important role here. Who are the large players? In the classical sense, these are often interbank algorithms, central banks, hedge funds, and other financial organizations that manage huge volumes of assets. These players, often referred to as smart money or institutional investors, differ from retail traders in their scale and strategies. For example, when we talk about large players, we mean operations involving millions or even billions of dollars, which significantly exceed the volumes that individual traders work with. Therefore, when a large player decides to buy or sell an asset for a large sum of money, they must take into account counter liquidity. Otherwise, they may face the problem of a lack of buyers or sellers when making a trade, which is likely to cause significant changes in the asset's price. It may seem that counter liquidity is the same as the market auction zones we talked about earlier. This is only half true because market auction zones are a concept that describes, in principle, any places on the chart that can provide buying or selling volume. We were talking about liquidity zones, but we didn't delve into the logic of why the price tests and reacts to them. Let's try to understand this now. Liquidity zones are often single fractals, but can also be clusters of fractal lows or highs. According to the smart money concept, which asserts that behind any fractals on the chart there are stop orders from market participants, we can conclude that these zones are of interest to large players. When someone opens a long position, they buy an asset. To close the position, they need to sell the asset. This is done through take profit and stop loss orders. If the stop loss is placed below a fractal low, it means there is sell-side liquidity in that zone. Conversely, when someone opens a short position, they sell an asset. To close the position, they need to buy the asset, which is again done through take profit and stop loss orders. If the stop loss is placed above a fractal high, it means there is buy-side liquidity in that zone. This is the counter liquidity that large players need to open and close their positions. When the price reaches a fractal low, large players buy the asset using the sell orders concentrated in that zone. Similarly, when the price reaches a fractal high, they sell the asset using the buy orders concentrated there. Since the volumes they work with are very large, the price often reverses from these levels. Also, liquidity zones are often visible to many market participants. When the price reaches such zones, traders start to act actively, placing their orders depending on the price reaction. This can amplify movement, creating volatility. Let's look at a couple of examples on the chart. On the 5-minute time frame, the price is in a phase of reaccumulation. In this context, I want to draw attention to fractal lows, where it is evident that the price is forming equal lows, which is likely where stop losses for players with long positions are located. For example, a buy order from the first fair value gap, and a sell order or stop loss below the nearest fractal low. The same situation applies to the second fair value gap, with a buy order placed higher and a stop loss again below these fractals. The same logic applies to the order block zone. Therefore, under all these fractals, a multitude of sell orders have accumulated, in other words, a liquidity pool that the big players are interested in. This will act as counter liquidity for their long positions. The price aggressively performs a liquidity raid on these fractals, simultaneously forming a fair value gap on both sides. However, visually, this volume seems insufficient. The logic repeats itself with a few more liquidity raids, after which aggressive buying volume enters the market and the price is pushed upwards. Another interesting aspect is that on the opposite side, we can also observe the accumulation of a liquidity pool, where it is highly probable that the stop losses of players with short positions are located. Thus, this buy-side liquidity acted as fuel for the price and assisted in the impulsive upward movement. The same situation applies here. Every time the price moves further down, it performs a liquidity raid on fractal highs. This allows larger players to open their short positions using counter liquidity, which in this case is buy orders. This type of movement is also called order flow. Now that we understand how liquidity zones work, let's look at one of the most common manipulations that form in the market. It looks like this. We have a bullish liquidity zone, such as a fractal low, and the price is trading slightly above it. To bring the price into this zone, selling volume must enter the market to absorb any counter-buying volume in this range and push the price down. This means that someone interested in this must open a short position. When this zone is tested, we often see the price reverse and move in the opposite direction. This indicates that a prevailing buying volume has entered the market because a large player has opened a long position using the counter liquidity. We often see a quick impulse move with the formation of a fair value gap, indicating a significant buying volume or a lack of counter liquidity. I also want to mention that often the orders that the large player opens to push the price down towards the liquidity zone can be used as counter liquidity for the long orders that he opens. This is something normal and can happen frequently in the context of such manipulations. The same mechanics apply in the opposite direction when we have a fractal high instead of a fractal low. If you are an experienced trader, you probably already guessed that this logic is identical to the power of 3 pattern, or what is also known as AMD, accumulation, manipulation, distribution. Another similar pattern with similar logic is called sell to buy and buy to sell, or Quasimodo. It all works identically, only the names and some characteristics differ. Let's look at a few examples on the chart for better understanding. In the context of an upward movement, the price at a certain moment consolidates, indicating a lack of liquidity to continue the movement. We observe the formation of several fractal lows where stop losses for players who entered long positions are likely to be located. Conversely, a few fractal highs have also formed, but the price performed a liquidity raid and created a rejection block. Now, the most crucial moment. The price tests this rejection block, and selling volume enters the market, pushing the price down towards the sell-side liquidity. At the same time, a large player opens a long position, creating aggressive buying volume that absorbs any counter-selling volume. The price moves impulsively upwards, simultaneously forming fair value gap zones. Here is another very interesting example of how manipulation can appear. The price is moving slowly downwards, indicating weak liquidity in the market. At a certain moment, buying volume enters the market, pushing the price towards fractal highs where buy-side liquidity is likely to be located. The large player uses these orders to open their short position, creating aggressive selling volume, and the price moves in the opposite direction. It also looks very similar to an order block, but we will talk about it in another video, because an order block is formed not only from liquidity zones, but also from inefficiencies, and has more interesting details worth paying attention to. Additionally, we will try to understand why the price tests and reacts to the order block zone. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment.